Welcome to the Deep Dive. You're tuning in because, like us, you're keen to stay ahead in this rapidly evolving world of digital assets.
Exactly, and that's what we're here for.
Today, we're really digging into the landscape for 2025. We got a stack of reports here. Fidelity Digital Assets 2025 Look Ahead, a Coinbase report on institutional interest.
Rivers look at Bitcoin adoption, too.
Right, and that report on corporate Bitcoin holdings. Lots to cover.
It's a fascinating mix of perspectives, definitely. Should give us a good handle on the shifts happening this year.
And I think the big question, maybe on a lot of listeners' minds, I know I've wondered it, is it, too late? Too late to get involved in digital assets?
It's a really common question. And to understand it, it helps to think about the bigger picture of technological change.
Okay.
There's this economist, Carlota Perez, who has a compelling theory on technological revolutions.
Right, I've heard of her work.
She argues that when these truly transformative technologies pop up, think the internet, the car, they don't just impact one industry, they kind of reshape the whole economy.
Okay, so how does that thinking apply here? To Bitcoin, digital assets generally.
Well, Perez suggests these revolutions often go through phases. There's usually an intense speculation period, a boom, sometimes a bust.
We've seen some of that.
Definitely. But then it's followed by a much longer phase, widespread adoption, integration into, everyday life.
So are we maybe moving out of that first speculative bit?
That's the idea. Potentially heading into a period of more, let's say, sustained practical use. And related to this, Jeffrey Ding, a researcher, points out the real impact isn't just the invention.
It's how it spreads.
Exactly, how broadly it diffuses and gets adopted in the decades after it's discovered.
Okay, so this is where it gets really interesting for me. Are you saying 2025 could be like a genuine turning point?
That's the core thesis we're exploring today. Based on the trends in these reports, 2025 has that potential. It could be a pivotal year.
Pivotal how? Like crossing the chasm?
Sort of, yes. Crossing that chasm into more mainstream integration. Across different fields, different industries. We're already seeing signs, right? More institutional interest, even some nations holding Bitcoin now.
That's a big statement. And the Fidelity report, it seems pretty comprehensive, covering a lot of ground.
It really does. We're going to pull out the key bits from all those areas. Adoption trends, macro stuff, Bitcoin specifically, Ethereum, stable coins, payments, the works.
Great. To give everyone a clear picture of what to watch this year.
Exactly.
Okay, let's start with adoption. Fidelity draws parallels between the internet's journey and digital assets. How does that comparison work?
Yeah, it's quite insightful. The idea is that these major tech shifts often follow a somewhat similar path.
They start small, niche groups.
Right. Early enthusiasts, fringe communities. Then gradually they gain wider acceptance. Think about the really early internet.
Oh yeah, dial-up modems, needing a computer science degree just to get online practically.
Exactly. And as the tech evolves, you get those smaller incremental innovations. Things get more user-friendly.
And the rules catch up. Regulations.
Crucially, yes. Regulatory frameworks start to develop. But, and Fidelity points this out, it's not always a straight line,
Not predictable.
Not at all. Different technologies face different societal hurdles, different legal responses. Some might stay niche because of ethics or laws. Others just explode and become essential.
So in that comparison, where are digital assets now? Fidelity mentioned the emergent stage.
They did. For the internet's emergent stage, they point to the late 80s. Academics using it mostly for sharing information.
Okay.
Now, digital assets are clearly past that initial phase, but the core idea holds, that early specialized adoption before broadening out. We're likely further along that curve than the internet was then, but the principle's similar. Gradual expansion from a core group.
And it's not just finance, is it? Blockchain tech itself could have way broader impacts, culturally, societally.
Oh, absolutely. If you zoom out, blockchain could potentially reshape things like digital identity, how we think about information privacy.
Even AI governance.
Yeah, even how AI is used and governed. The report notes this growing recognition that decentralization adds value for security, for making systems more resilient, less reliant on single points of failure.
Makes sense. Harder to attack a distributed system.
Precisely. And we're seeing these blockchain platforms becoming more modular, customizable for specific needs.
Tailored solutions.
Right. Plus, there's this public demand, right, for more control over our data, and that's pushing development of privacy tools within the digital asset space.
Feels like there's a tension, though. That original decentralized dream versus, big companies getting involved, regulators stepping in.
That's a really important question. Which way is it heading? The report suggests we might see a balance emerge.
A middle ground.
Perhaps, where you keep the core principles, decentralization, privacy, but adapt to the realities of wider use, commercial needs, regulation. But like they say, innovation is kind of stochastic, unpredictable. The exact path isn't set.
Okay, let's pivot then. Bitcoin specifically. You mentioned earlier this potential shift in perception. Less growth stock, more digital gold. What's the latest thinking, especially with those macro factors?
Right, so back in their 2024 analysis, Fidelity's team was wondering if Bitcoin would start trading more like gold, a safe haven asset.
Did it?
Well, we saw some co-movement earlier in the year, yeah, but it also kept correlating with tech stocks, suggesting that, overall risk appetite was still a big driver.
So looking ahead to the rest of 2025, what are the main macro drivers now?
They're really emphasizing two things: liquidity in the financial system and inflation expectations.
Liquidity and inflation. Okay,
Right.
and the Fed's cutting rates now? That usually means more liquidity, right?
That's the typical effect, yes. And the report points out that money supply measures, things like USM2, global M2, they're starting to tick back up.
They also think any, future market bumps, disruptions, they'll probably be met with more liquidity from central banks. It's become the standard playbook.
And, historically, more liquidity. Good for digital assets.
Generally been positive for prices, yes.
Okay, what about inflation? Feels like we never stop talking about it.
Which brings us to that less discussed scenario. Stagflation. High inflation, but low or falling growth. How would Bitcoin handle that? Yeah, it's really seen it before.
That's the million-dollar question, isn't it? It's a key unknown. Bitcoin didn't exist during a prolonged stagflation. It saw that brief downturn with COVID, sure.
Right.
But the high inflation came after the GDP contraction, not really alongside it. So the report stresses its performance would really depend on the policy response, fiscal and monetary.
So if governments and central banks try to fight the stag part, the slow growth, with more spending, easier money.
That could potentially help Bitcoin, maybe with a lag, but beneficial.
But if they focus on the inflation part, aggressively tighten money supply, cut spending.
That could create headwinds? Definitely.
Interesting. The report mentioned gold in the 70s stagflation.
It did. Gold actually saw its biggest rally during the second wave of inflation back then.
Huh.
So the conclusion here is really about Bitcoin's potential portfolio value across different scenarios. It could benefit in recessions, assuming stimulus follows.
Which it usually does.
Right. And it could benefit if risk assets and inflation keep rising. The least likely negative scenario for Bitcoin, they suggest, would be a really sharp reversal. Big cuts in spending, shrinking the money supply.
Okay, let's shift to Ethereum. The big buzz there is the roll-up-centric roadmap. How's that looking as we go through 2025?
Yeah, that whole roll-up strategy is still a hot topic,
Mm-hmm.
especially since the main network fees, layer 1 fees, dropped after the Deneb Cancun upgrade.
Which was designed to help roll-ups, right? Make data cheaper for them.
Exactly. Cheaper data via those new blobs. The core idea is scaling Ethereum, making it cheaper, faster, without losing the security and decentralization.
But the lower layer 1 fees, does that hurt Ethereum's revenue overall?
Well, the report's view is that the revenue from this new blob market isn't likely to, immediately make up for the drop in traditional transaction fee revenue. Not right away.
So it's a long game.
It's seen as a long-term play to boost network effects, attract more users, more activity to the whole Ethereum ecosystem, including these layer 2s.
So these layer 2s, these roll-ups, they're really vital for Ethereum's future then. How does that relationship work? What's the give and take?
It's really mutualistic.
Yeah.
Ethereum layer 1 provides the bedrock, security, decentralization. The layer 2s handle the heavy lifting, most of the transactions much more cheaply.
And then they settle back to layer 1.
Periodically, yeah. They post a summary back.
Yeah.
So users get cheap L2 execution, but still rely on L1 security. Plus, L2 activity helps distribute the ETH token.
And what do the L2s get out of it?
Oh, massive benefits. Ethereum's security, its huge existing user base and liquidity. That's invaluable. And they can focus on their specific tech advantages. But cheap data on Ethereum and that deep liquidity pool, absolutely essential for the whole roll-up thing to work long-term.
So Ethereum's main goal isn't high L1 fees anymore.
The report suggests the long-term vision, at least according to core devs, is for revenue to come more organically, from sheer network growth, adoption outpacing new ETH issuance.
So low fees on layer 2s are actually a priority.
A key priority for the devs and the foundation, yeah. Because if L2 fees get too high, projects might just build elsewhere, on other chains.
Makes sense. So expect more L2s in 2025.
Definitely. More announcements, more growth, especially for specialized use cases that really benefit from customizing their whole tech stack.
Okay, and the inevitable comparison, Ethereum versus Solana. Still the main contenders in that smart contract space.
They're definitely the two most often compared, and for good reasons. If you look at fundamentals developer activity, total value locked, TVL, stablecoin supply, Ethereum still leads.
But Solana's had momentum.
Yeah, Solana's seen faster growth in revenue and TVL recently, and it's captured a lot of community mindshare, a lot of buzz.
But the report adds a caveat there about Solana's revenue.
It does. Points out that a big chunk of Solana's recent revenue is from meme coin trading, which is generally seen as more, cyclical, speculative.
Compared to Ethereum's main driver,
Yeah.
which they see as Uniswap fees.
Right. Uniswap and other decentralized exchange fees. Now, you could argue both have speculative elements, sure. But the view is Ethereum's fundamentals might be slightly less tied to pure hype, potentially more stable long-term.
But short-term prices, different story.
Absolutely. Short-term is often narrative-driven, market sentiment. Solana might have more tailwinds there in 2025 because of its big Fire Dancer upgrade.
Promising much higher TPS.
Exactly. Big transaction speed increase expected. Ethereum's next upgrade, Electra, is crucial too. It helps L2s by increasing blob count, boosts core security.
But less hype from an investment angle.
Probably less immediate hype compared to Fire Dancer, yeah.
Yeah.
It doesn't fundamentally change the ETH investment case in the same way a massive TPS boost might.
Ethereum still has some built-in advantages though, doesn't it? Accessibility.
For sure. Big advantage currently is accessibility via ETPs, those exchange-traded products. Much easier for traditional investors.
And no guarantee Solana gets those anytime soon.
Still uncertain, so the report kind of suggests Solana might have short-term momentum, but Ethereum's stronger fundamentals could lead to outperformance later, as investors maybe shift focus back to underlying value, utility.
Interesting point, too, that L1 transactions on Ethereum haven't tanked, even with L2 growth.
Yeah, that indicates the base layer still has real utility, even with lower fees now. People are still using it directly for certain things.
And the whole deflationary ether idea, is that on the horizon?
It's a possibility longer term. Future upgrades aim to reduce ETH issuance. If fee burning eventually outpaces issuance, then yes, net deflationary.
But not likely in 2025.
Unlikely in 2025. The focus now is really on L2's flourishing, facilitated by more blobs coming with Electra.
So keep an eye on layer 2 fees staying low, throughput increasing.
Exactly. And watch those upcoming upgrade features. Max Eve, more blobs, PeerDAS eventually, EOS, Verkle trees, all crucial for scaling and efficiency.
Electra first half of 2025.
Expected H1 2025, yeah. It got streamlined, a bit less of a major overhaul now, more focused on merge cleanup and that near-term L2 boost, increasing blob target to 6, maybe 9.
And PeerDAS later on. That sounds important.
Potentially very bullish, yeah. Estimated for maybe 2026. That could really crank up blob throughput, solidify the path to super low transaction costs, and maybe even start generating that free cash flow for ETH holders.
Okay, let's circle back fully to Bitcoin now. This mining fee squeeze you mentioned. What's driving that?
It's this dynamic of Bitcoin integrating more with TradFi.
Are people using custodians, ETPs, less self-custody?
Exactly. Less direct on-chain activity from end users. And at the same time, miners got hit with that double whammy in 2024. Average fees declining and the block subsidy halving in April.
Cut in half. Ouch.
Yeah, less reward per block.
And those Bitcoin ETPs, the spot ones, played a huge role in the fee drop.
Oh, absolutely. Launched January 2024, right. Suddenly, a super convenient, regulated way for traditional investors to get exposure. No need to handle keys, wallets.
And the demand was strong.
Massive. U.S. Bitcoin ETPs now hold over 1 million Bitcoin collectively. That's like 5% of the total supply.
Wow.
And this trend of more institutions getting involved, expected to continue through 2025, which likely contributes to this longer-term environment of, well, lower base layer fees.
Lower activity on main Bitcoin chain. Is that bad?
The report actually frames it as potentially positive for scaling, for broader use.
How so?
Well, this migration to third-party solutions, layer 2s, ETPs, it takes pressure off the base layer. They even imagine scenarios where, say, Visa batches millions of payments into one single settlement transaction on Bitcoin.
So concerns about low fees making the network insecure? Overstated?
Likely overstated is the view. Sure, higher cost miners might drop out, but regions with super cheap energy, they'll likely keep mining.
And the big players have skin in the game. Exchanges, custodians.
Exactly. They hold tons of Bitcoin. They have a massive incentive to keep the network secure, even if they have to mine at a slight loss sometimes. It's like an operating cost for their main business.
So security could hold up even with lower fees.
That's the argument. They even float ideas like getting profitable Bitcoin companies, maybe even nation states, into mining just for network security. The key, they suggest, is convenience via these third parties. That's how you scale meaningfully without wrecking network health.
What about ordinals, inscriptions, runes? They caused that fee spike for a bit. Sustainable fix for miner revenue.
Seen as more of a short-lived thing. Yeah, the runes launch around the halving boosted fees temporarily.
But it's basically just another way to do meme coins, like on Ethereum or Solana.
Pretty much. Another way to launch and trade speculative tokens. There's no real novel, sustainable utility there that's going to drive high fees long-term.
So the bubble popped already.
Seems like the initial hype faded fast. Fees came back down after that spike. The expectation is that this kind of speculative stuff on Bitcoin's base layer will probably trend down. Unlikely to hit those peaks again, maybe just small spikes during big bull runs in 2025.
Okay, but even with lower fees, innovation on Bitcoin isn't stopping. Building on Bitcoin.
And not all. New ideas for scaling, capital efficiency, they keep emerging for 2025, even with muted L1 fees in 2024.
Like what? What's bubbling up?
We're seeing things like BitVM2 for more complex computation, ZK proofs for privacy, different kinds of rollups, snarks, PyPs for efficiency, even stuff exploring hash collisions.
All aimed at scaling and privacy.
Broadly, yeah, making Bitcoin more capable, more usable, while sticking to its core principles.
And a common theme is soft forks could help.
That's a key point. Many of these things can be implemented without changing Bitcoin's code, but soft forks protocol upgrades could make them way more efficient, less complex.
Which brings us back to covenants. That seems to be the big umbrella for potential soft forks.
It is. Covenants are rules about future spending. Two big proposals get mentioned. OP-Check Template Verify, or CTV.
BAP 119.
Right. And OP-Cat, BIP 420.
Okay, unpack CTV first. What would that enable?
So CTV allows you to restrict how Bitcoin can be spent later. Enables more complex smart contracts, things like better transaction batching to ease congestion, efficient discrete log contracts for private agreements.
Vaults for security.
Exactly. Vaults. Storage, where you define the withdrawal rules, like maybe a limit per day, or funds can only go to pre-approved addresses, or there's a time delay if sending somewhere new.
That sounds useful for security.
Big time. And CTV could also enable non-interactive Lightning channel creation, setting up payment channels more easily, improving the Layer 2 user experience.
Okay, and OP-Cat. What's that about? Concatenation.
Yeah, it reintroduces an old opcode, basically lets you stick data together on the stack, like a digital stapler.
Why is that useful?
It enables more complex covenant functionalities, merging data sets within a transaction, again, boosting Bitcoin scripting power for more advanced contracts, but still staying decentralized.
These sound like major upgrades.
Yeah.
What's the chance they actually happen?
The big question. Both BIPs are under community review. Discussions definitely picked up during those high fee periods with ordinals and runes.
So another fee spike might push them forward.
Might lead to calls for a speedy trial, yeah. But gauging community support. Always tough with Bitcoin. Decentralized, resistant to change. Even the Fidelity researchers disagree internally on the best path.
So it depends.
Yeah. The report kind of says, unless we get really good trust-minimized ways to use Bitcoin off-chain with easy exits back to L1, the demand for these on-chain tools should grow.
And what about keeping mining itself decentralized? Any movement there?
Yes, definitely efforts ongoing. A new mining pool, Ocean, launched in 2023, specifically focused on decentralization. They even tried filtering ordinals initially.
Using custom software.
Yeah, using Knots, a customized Bitcoin core client. And this led to Datum decentralized alternative templates for universal mining.
Okay, what does Datum do?
It's a protocol letting individual miners within a pool create their own block templates, decide which transactions they want to include.
Instead of the pool operator deciding for everyone.
Exactly. More miner autonomy, similar to what Stratum v2 aims for. Interestingly, miners in Ocean are using Datum, but some are using it to bypass Ocean's own intended inscription filtering.
So much for that.
Well, most Ocean blocks aren't including inscriptions right now, suggesting miners are using Knots to filter. But, their result hasn't really been tested by another crazy high-fee inscription period yet.
How big is Ocean now?
Still small, maybe 1% of network hash rate. But it's a notable step towards more mining decentralization.
All right, let's switch gears again. Stablecoins, big trend in 2024, still growing.
Absolutely. The report doubles down on stablecoins being a major potential use case,
Yeah.
especially alongside asset tokenization.
But not perfect yet. Still evolving.
Still evolving, yeah.
Right.
Expect more work on counterparty risk, compliance, integrating better with traditional payment rails, cross-chain use, and meeting that demand for yield-bearing stablecoins.
We've definitely seen trading volume surge.
Oh, yeah. New issuers, more liquidity. Spot trading volume hit over $120 billion one day in November 24. New highs. On-chain weekly volumes over $50 billion, too.
But it's more than just trading fuel.
Right. Much more. It's a prominent use case in itself. Global access to USD-pegged tokens, aiming for faster, cheaper 247 global payments.
And adoption metrics were up. Active addresses, transfers.
New highs in October 24. 4.4 billion transfers that month. Still tiny compared to Visa, obviously.
Sure, 234 billion for Visa in 2023.
Right. But the growth shows endurance driven by trading, yes, but also other things. Remittances, cross-border payments, just accessing USD as a store of value.
Especially in emerging markets.
Exactly. That Castle Island Ventures survey found people using them for saving in dollars, better FX rates, earning yield.
And remittances is a huge market. $850 billion estimated in 2023.
Huge. And costly. Average fee over 6% for a $200 transfer end of 2023.
Stablecoins could undercut that, especially on layer 2s.
That's the potential. L1 Ethereum fees can still be high, but L2 fees are down to pennies. That's crucial for scaling to remittances, real-world asset tokenization.
Which brings us back to tokenization. Stablecoins are key there.
Intrinsically linked, yeah. Tokenizing bonds, equity, funds, trillions of dollars worth of assets. That could massively drive demand for stablecoins as the medium of exchange, the liquidity layer, the fiat bridge, and smart contracts.
And regulation is catching up, like MiCA in the EU.
MiCA is a big milestone. Effective June 2024, gives legal protections to holders, sets clear rules for issuers, licensing, reserves, governance, compliance, needs 1.1 liquid reserves with a third party.
Could be blueprint for elsewhere.
Suggests other jurisdictions might follow suit. Yeah, more clarity helps adoption.
What other developments in stablecoins and DeFi for 2025?
We might see wallets like MetaMask, Phantom adopt payment for order flow, PFOF.
As a business model.
Monetization. Yeah, routing trades for a fee represents more commercialization. We'll also see continued momentum for layer 2's cheaper, faster, better cross-chain interaction, vital for handling DeFi's load.
Like Coinbase's base chain.
Good example, built on Optimism's OP stack. Successful L2 launch.
Anything more futuristic? AI, DPIN.
Yeah, interesting stuff emerging. AI agents in DeFi for portfolio management, optimized trading, automated loan adjustments, even DO governance.
And DPIN, decentralized physical infrastructure.
Right. Building real-world infrastructure wireless, compute power via decentralized groups, blockchain coordination, token rewards. Think Helium for IoT, Render for GPUs.
Still experimental.
Mostly experimental phase, yeah. Strong user adoption from the token rewards, though. Might see traditional utility companies experimenting here in 2025.
And AI accessibility. Things like BitAnswer, Render.
Yeah, making advanced AI more accessible, decentralized model sharing, validation, GPU compute. Expect more open-source AI models in 2025 for societal good protein mapping, genomics, medicine, drug discovery.
And that Coinbase report showed huge institutional interest ramping up.
Massive. 83% plan to increase crypto allocations in 2025.
And they're using stablecoins for more than just trading.
Yeah, yield generation, FX, cash management, payments. Citi also predicted faster stablecoin adoption on-chain, especially in DeFi.
And institutional DeFi use is set to jump.
Coinbase survey found current use at 24%, expected to hit nearly 75% in the next 2 years. Huge potential growth.
Plus corporate Bitcoin holdings are up too.
Surged 16.1% in Q1 2025, according to A-Invest. Growing conviction there too.
Okay, so pulling this together, what are the big drivers pushing this towards mainstream adoption diffusion in 2025?
Well, the spot Bitcoin ETPs were huge, unlocked massive demand, institutional and retail, got pensions, endowments allocating.
So who's next? What's the next big wave?
Potentially nation states. Central banks, sovereign wealth funds, government treasuries, establishing strategic Bitcoin positions in 2025.
More than just seizures, actual strategic buys.
That's the potential shift. Right now, government holdings are often from seizures, with rules about handling them. But maybe more countries follow Bhutan, El Salvador, see the returns.
Could become riskier not to hold some for certain nations.
That's the argument, especially those facing inflation, currency debasement. Not allocating could become the bigger risk.
And in the U.S., talk of a strategic reserve.
Vocal support, yeah. Trump, Senator Loomis, But whether it actually happens in 2025, uncertain. Loomis's Bitcoin Act, if passed, could push other nations, maybe force covert buying.
So, political winds shifting.
Definitely strong interest from the incoming administration Congress for more favorable policy. How high a priority it is, unknown, but the perception shift is clear.
Yeah.
No longer just a fringe thing. It warrants political attention.
And the ETPs themselves, still mostly retail holding them.
About 80% retail early on, yeah. But the number of institutions is high for a new product launch. Over 1,000 entities, hedge funds, pensions, banks.
Bigger ones take longer. Due diligence.
Exactly. Stricter oversight means more time. Demand is also partly fueled by that cash and carry trade.
The basis trade.
Right. CME Bitcoin futures open interest is up over $12 billion since the ETPs launched. And now we have options on the ETPs too. Strong institutional demand there.
So expect more TradFi crypto products.
Reasonable expectation, yeah.
Yeah.
More structured, passive, active digital asset products in 2025. Growing interest might push more asset managers, both crypto native and TradFi, to launch bespoke funds.
And tokenization again. The killer app of 2025.
Potential killer app, yeah. After stablecoins maybe took that title in 2024, we're seeing tokenized treasuries, money market funds, global bonds, private credit, commodities, funds, equities.
The value is growing fast.
$14 billion nominal on-chain now, up from $8 billion in 23. Could double in a year, approach $30 billion by end of 2025. Big banks, asset managers are all over it for efficiency, transparency.
Bitcoin lending, too.
Growth potential.
Substantial growth potential in 2025. Again, TradFi acceptance helps. Institutions with strong balance sheets have an edge here, like Cantor Fitzgerald's plan. $2 billion financing.
Prime example. Launching July 2024. Services like that unlock more potential, bridge TradFi and digital assets further.
And let's not forget Bitcoin's layer 2, Lightning. River's report showed huge growth.
Incredible growth. 1,212% in 2 years, according to River. Shows Lightning is really gaining traction for faster, cheaper Bitcoin payments.
River also looked at who holds Bitcoin.
Yeah, interesting breakdown. Satoshi, still the largest estimated holder, untouched coins. Public companies like MicroStrategy, Tesla. Institutional products like BlackRock's ETF with over 500,000 BTC now. Whales, some governments.
Concentration at the top.
Some concentration, yeah. 4 addresses hold 100K to 1 M BTC. The next 93 biggest hold over 2 million combined. ETFs and funds hold nearly 6% of supply.
But ownership isn't control, right?
Crucial point River makes. Ownership doesn't equal network control. That remains decentralized. Private keys control the Bitcoin.
So wrapping this all up, 2025 looks like it could be genuinely pivotal. Major evolution for Bitcoin and Ethereum. Stablecoins and tokenization booming, big players getting more involved. Institutions, maybe even nations.
That's the picture emerging, yeah. And going back to your first question, is it too late?
Yeah.
Well, the hyper-speculative phase might be receding, but this era of sustainable adoption, real integration, seems like it's just getting started. So for thoughtful engagement, probably not too late at all.
Really makes you think. With all these parallel tracks evolving,
Yeah.
what are the surprising things we haven't even thought of yet? What unexpected integrations might pop up in the next few years beyond these projections?
That's the exciting part, isn't it? The unforeseen applications.
Definitely something to keep watching. Thanks for joining me for this deep dive.